All right, as promised, trying to do more of these quick value posts in video format for you, just to give you the quick rundown. So this week I looked at Terex. Terex, I think that's how you say it. TEX is the ticker. This is a cyclical business. Actually, I first found it. I was screening for companies that have had kind of a flat share price over a number of years. So really not minimal volatility, but pretty tight within where it was 3 years ago, 3 or 4 years ago, and where it is today. And I saw this name, and I actually thought it was maybe more of a COVID over earner play. When we fast forward to this backlog chart, right? Huge spike up during the COVID years. And now it's all unwinding here in 2024, and still has another year or so of unwind coming. Um, I don't actually know that this is really a COVID over earner though. Oh, there we go. I don't know that it's a COVID over earner as opposed to just the normal cycle for this business. So I'm pretty far removed from it, but we'll get into it in a moment. So it's cheap. The share price has been flat for a long time. It's a cyclical business. So maybe you're paying a low valuation on like a cyclical low or cyclical trough in earnings. That's the potential setup, right? I don't know that that's actually the case, but that's maybe what we're looking at here. So they make industrial equipment, so like cranes, boom lifts, utility trucks, right? All this stuff, right? They have a nice investor day presentation laying out all the things that they make. Let's flip over to that. Where is it? Oh no, I want to save that chart. We'll come back to that. Um, so they play in a number of different markets for like construction verticals, utility verticals, waste management. They've got two main segments: MP and AWP, aerial work platforms and materials processing. I'm going to come back to this ESG because they just acquired that. So those are the two main segments, and that's what we saw in that backlog chart that spiked up and then rolled over. So this is a capital goods company, right? Like they sell into their customers' capex spend annually. So it's a heavy machinery business, right? So like Cat and Deere are probably the quintessential names that people recognize when they think capital goods, right? So just have the picture of cyclicality in your mind when you're thinking about a business like this. So, all right, that's the backdrop. Uh, and actually, what would be really interesting is if you pulled up the capex spend for like URI or Herc Rentals, right, and just saw like, all right, what do their trends look like? That probably would be a big influencer for this business, at least in a couple of the verticals they're in. All right, ESG. So, what made this super interesting, as opposed to just the timing of the cycle and the valuation, is they just bought this company from Dover, and Dover's are one of those just impressively high ROIC. What are the Constellation CEO calls it high performance conglomerates, right? So Dover's super well run. So they bought this business from Dover, Environmental Solutions Group. I think they basically make garbage trucks. So I think it's a garbage truck manufacturer, right? And there's like an aftermarket parts and digital component to it, and then they make like trash compactors and stuff. So, and I think they're the leading player in that market. But they paid $2 billion for it. This is a $3 billion market cap today, so I think that's a pretty significant bet, right? So, and they did it with all debt. They did it with all debt. Where is this? All right, that's the deal overview, right? Purchase price 2 billion, cash free, debt free, and this is hilarious, right? So there's 25 million of synergies. They're saying that they're only paying 1.725 because of this 275 million of present value tax benefits. I think they're just taking the deal amortization, like the cash savings they'll get from that, and saying that that lowers the purchase price. But they're going to get that over like 10 years, right? So it's basically the equivalent of shielding some income tax because of the purchase price. So I think this is a really dumb argument. They actually paid $2 billion. So uh, I have that at 11x EBITDA. That's what they paid. And here's the sources and uses. So it's all new debt. They actually put 4% down, right? So 4 down, 86 or 96 borrowed to buy this thing. So hugely levered bet on this business and how it performs. And I went through it in the write up, but there's some attractive facets to this business. They're a leading player and it's a growing market. it's got a good organic growth profile. They've done acquisitions in it as well, so maybe there's some more tuck-in opportunities along the way, right? More growth stuff, competitor offerings. Let's see. Oh, that's the synergy estimates, 25 million. Um, and it has huge EBITDA margins. So compared to their other businesses, where is it? That's not a good chart. Yeah, so this is a 20% EBITDA margin business with really low capex, like 1.5% of capex, 20% EBITDA margins, and good organic growth. If you ran a screen for industrials with 20% EBITDA margins and less than 2% capex to revenue, I bet you're going to get only like 15x EBITDA businesses, right? Like the ITWs and the Dovers of the world, right? So I don't know, maybe it's a good company that they bought. Let's come back to this write up. But I think they paid a full multiple for it, right? I don't think you can include the tax savings as a legitimate argument. That'll help free cash generation. But anyway, I looked at the Dover transcript and they wanted out of the business because they thought it was too cyclical. So, they're unloading it because of cyclicality too. So I don't know. We'll see how this plays out. But and I have all these fresh memories of like big acquisition blowups recently. Celanese comes to mind, like just absolutely clobbered. So I think the stock will be hugely dependent on how this acquisition plays out. So anyway, a couple of reasons why I find it interesting, and it's just sitting on my watch list for now. But the MP and AWP segments, right? This is the spike up in backlog, right? You see it unwinding, and they're calling for another 10 to 12% decline. Actually, I think one segment's high single digit decline at MP and double digit decline at AWP. That's what the 2025 guidance is for. So like they're not out of the woods yet, but maybe the expectations are resetting enough that 2025 guidance could be the low point. Maybe, right? That's the potential thesis that I think you'd want to evaluate further from here. Yeah, so earnings spiked alongside this backlog spike, and they're also declining like this backlog is declining. So that's the backdrop, right? That's the setup for the MP and AWP segments. And if you buy the stock today, you're basically buying it, baking in that 2025 further decline, right? Okay, then part number two, the ESG business, right? This looks like an upgrade in terms of business quality from what they had before, right? Both of these segments are, 12 to 15%, maybe 13 to 17% EBITDA margin businesses, and this one looks like consistently 20 plus, right? Lower capex needs than the existing segments too. I don't know about cyclicality. I guess we'll find out, but if they bought it from Dover, it's probably pretty well run at this point. So it's probably an okay business if it was living inside of Dover previously. And they gave us the 22, 23, and then this is just, TTM as of 6/30/2024 when they bought it. So I haven't looked to see, how are they doing since then. But, Dover is saying, oh, we got 13x EBITDA for this thing. So here's their reported EBITDA number, this 155.8, and then here are some add backs that they took to get to their adjusted number for the Terex side. I don't like seeing this corporate allocation number, 15 million TTM add back, because they're basically saying like, oh, we won't have to take on any additional overhead staff to incorporate this acquisition, which doesn't always pan out. So anyway, we'll see if they can maintain these margins go forward. The business had a huge step up, right? I'm just kind of calling out some of the things that I'm like, oh man, I'm worried about how the performance is. 110 million, 150 million, and then 174 million. That's the 3-year EBITDA profile for that business. So I don't know, what will 25 hold for that company? But on the surface, it's got a good fundamental profile. You've got organic growth, good EBITDA margins, low capex needs, so probably a really cash generative business, and maybe less cyclical end market, right, than construction and utilities. So valuation, calling for basically 5.4 billion sales. Remember, they had a big acquisition loaded in there, so not like for like compared to 2024. 470 to 510 EPS. So it's a $45-$46 stock. You're basically getting $5 of earnings. So less than 10x earnings, and free cash is almost 100% conversion, right? Almost. And then this is just a view of the stock price. PE, next 12-month PE over time, right? You can see the cyclical periods here. Median is 11x. It's trading at, a little over 9 right now. And then these are the consensus estimates for EPS over the next 12 months. So you can see, those estimates were rising, and then they came down as the cycle started to come down, but now they're kind of leveling out and coming back up a little bit. So maybe close to that inflection point. I think it's cheap mostly because of the debt, right? Cyclical business with $2.2 billion of debt and $660 million of EBITDA, so that's pretty levered. But again, we could be looking at cycle trough. I don't know. So my guess is they'll dedicate almost all of cash flow over the next 2 years, maybe, to getting debt down, so that it gets into their target mid-cycle leverage ratio. So basically trading at 8x EBITDA, $3 billion market cap, $2.2 billion of debt, $660 million is the EBITDA guide. So anyway, 8x EBITDA, less than 10x earnings is what you're paying for this today. So pretty interesting, right? Pretty interesting. So I laid out a couple of scenarios that maybe get you to $60 a share. If you believe that 2025 is trough and 2026 estimates are believable, 740 million EBITDA, 575 EPS. That's the current consensus for 2026, right? So I don't know. It's kind of an interesting setup. Could be cheap. The profile is, here's what they're calling for: 75 to 100% free cash flow conversion and 2.5x net debt to EBITDA. Those are the goals, right? This is from a 2022 Investor Day presentation. So at that point in time, they were doing $4 a share, thinking they could get to 8 or 9 organically. So it has to be really cycle dependent for that to be the case. So this is a good slide deck to give you the layout of everything that's going on in the business. And I linked that down here at the bottom. So 10K Investor Day presentation, which has tons of good detail on the actual businesses. And then this is the ESG acquisition presentation. So I don't know. I don't think it's a COVID over earnings story as much as it is just a cyclical, where are you in the cycle type of story. But I like the fact that they bought a company from Dover. I mean, not that everything they touch turns to gold, but that could be the case. So take a look. If you've looked at the name and you know more about the industry and the end markets, leave me a note. Check out the write-up at valuedon'tlie.com. Thanks.